So the second learning objective, okay? So second learning objectives is about record purchase under perpetual inventory system. So purchase are recorded in the inventory account. What should be part of the purchase cost? Well, you should consider the freight cost and the tax cost. So it's not just the price, right? It's not just the goods price. It's gonna incur some freight cost. You're gonna ship the item to your inventory, to your warehouse. You have to pay the government tax if they are not refundable, right? And sometimes you may return the purchased goods to the supplier if you are not happy with the purchase. Sometimes to encourage you to buy, the suppliers will give you discount, right? Give you discount. So those will be all affected that cost of goods purchased. Okay. In Canada, for some goods or services, they charge a goods and services tax, right? GST. HST is for some other provinces, not for Alberta. Alberta has no provincial tax, provincial sales tax, right? So good for people living in Alberta. So you only concerned about the 5% GST, but the provincial sales tax is 0 in Alberta. In British Columbia, it's like 7% or 8%. In Ontario, GST and the provincial tax together called HST, that's 13%. So think about it, right? For most of the purchase, you are paying 5%, but in other provinces, they are paying probably 13 or 12%, right? Even some provinces, even up to 15%. Okay, so this tax you paid, okay? But this tax should not be included as your cost of purchase. You know why? Because when you sell these goods, you are going to collect the GST from the end consumer. Okay, so they are offset. Okay, they're offset. So you paid a portion, but you are able to collect it from the end consumer. Okay, so in the fact that you pay this money, but you get it back from the end consumer, right? So it's evened out. So that's why this GST, HST should not be part of your purchase cost. FOB, free on board. This refers to where the title ownership of goods transferred. This is important, right? Because only when you owned these goods, you need to record it on your book. If you don't own it, right, it's not your item. You should not record it on your book, right? Another question is, when an item becomes my goods, when did I start to own these goods, right? So that's why we are talking about FOB here. This refers to where the title ownership of goods transferred. So let me ask you a question, okay? You are a retailer. You buy from a wholesaler a truck, like a truck load, right, full of eggs, okay? A very, very big truck with like thousands, like millions of eggs, right, in that truck load. So that truck was driving, okay, and then was in a car accident, and the truck was tipped over, and all the eggs is a disaster, right? All the eggs are broken, right? It's disaster. Okay. Is this your law? Is this your loss, or this is the supplier's loss? Right? The truck is on the way from it's just between the supplier and you, right? Between the wholesaler and the retailer. The truck is just happened on the way, shipping the eggs from the wholesaler to retailer to you, right? On the way, and the accident happened. So that's a loss. This is the supplier's loss, or this is your loss? Okay, I saw people say supplier's loss. Anyone else have different opinion? I think two students responded to me saying this is a supplier's loss. Anyone else think otherwise? You all think this is a supplier's loss? Okay, because you are assuming that the ownership won't pass to the buyer until the eggs reaches the warehouse of the buyer, right? That's your assumption. So in your assumption, you are assuming that the ownership will not be transferred from the supplier to the buyer until, right, the truck deliver the egg, right? So that's called FOB destination. So in your assumption, that's called FOB destination. So as FOB destination means that the goods ownership will be transferred to the buyer, okay, at the buyer's place of business. And the seller will pay for the shipping, okay? So your answer is correct if the contract has a term of FOB destination. But there's another option, right? It's just really about the negotiation, right? The other option is called FOB shipping point. So the minute the eggs left the seller's place, okay, that ownership, the risk was transferred to the buyer. And the buyer will pay for the shipping. Okay? So if the term is FOB shipping, would your answer change? If the contract has a term FOB shipping, that means the ownership is transferred from the seller to the buyer at the shipping point. Yes? Okay, good. So you can see that it's really depending on the contract. So you want to make the difference of the FOB destination versus FOB shipping point, right? So this is important because this defines at what time you should record your purchase, right? You can record it early because you don't own it, right? In that example, it's FOB destination. The truck is still on the way. You don't recognize, oh, I already have the egg. You know you don't, because guess what? Those eggs were broken on the way to your warehouse, right? You don't own it. So only when these eggs arrived at your warehouse safely, right? You put them into your warehouse. That's the time it's your inventory. That's the time you can record the egg, the purchase, right? You can record purchase. Otherwise, no. Yeah. So I mentioned about FOB destination. Okay, the seller will pay for the shipping cost. The seller owns the good until received by the buyer. When the goods in transit is still owned by the seller, seller will take the risk. FOB shipping point, okay, the buyer owns the good as soon as the goods shipped, and the buyer paid for the shipping cost, and the buyer take the risks of the goods in the transit. Okay, purchase returns and allowance. A purchaser returns the goods to the seller and receive a cash refund or credit. The buyer may choose to keep the merchandise if the seller is willing to give allowance deduction from the purchase. Okay. So either you can return the goods to the seller, okay, and then you get the money back, right? Because your goods sucks, right? I don't want it, so now I'm returning this to you. Give me the money back. Or the seller would be like, okay, you can, if you can still sell it, it's still some sort of usefulness. You keep it, I will give you a credit, right? So next time when you buy, that there is a price deduction, right? Okay, so in both cases, that your cost of goods purchased should be decreased. Your cost of goods purchased should be decreased. Discount. Purchase discount means if you reach certain volume, certain level, they will give you a discount, right? If they say if you purchase more than $2,000, you get a 2% discount, right? So then you made a purchase of 2,000, you should not record a cost of purchase 2,000 because you have a discount to 4%, right? So you can record as 1960, right? $1,960, right? So that would be your cost of purchase. The $40 is due to the purchase discount. Adjusting entries at the year-end period. So regardless, you have seen, right, regardless of whether it's perpetual or periodical inventory system, you have to do a physical inventory count, okay? You have to do a physical inventory count. And the inventory count has to be, the inventory balance has to be adjusted to reflect the actual inventory on hand, right? Because if it's theft, if it's due to theft, you have to be honest because you don't have that many inventory, right? So you have to adjust your inventory account balance to reflect the actual level of inventory. Okay, so let's see some of the transactions journal entry. When you purchase merchandise for resale, well, you could either use cash, right? Or you buy on accounts payable. So when you have the merchandise, your inventory increase. So you debit your inventory, but you're going to use cash, your credit cash. If you don't use cash, you're going to increase your liability. So you credit accounts payable. That's the first entry. Paying freight cost on merchandise purchased FOB shipping point, right? So if it's FOB shipping point, right? So you are paying, the buyer will pay for the freight cost. And that cost should be added to the inventory. So you debit the inventory, credit cash. And then receiving purchase returns or allowances from suppliers, right? So this is the time you were given the credit, okay? You were given the credit for purchase returns or allowances, right? So that will reverse the purchase journal entry, right? Because purchase is this way, return is the opposite way. So the journal entry should be the opposite, right? If you take a look at your purchase journal entry, you debit inventory, credit cash or accounts payable. So this is the purchase coming to you. Now you are returning it. So that's leaving you. So your journal entry should be the opposite. So you debit cash or accounts payable, you credit the inventory. Paying creditors on account with discount period. Okay. So this is a time that you have accounts payable, you owe people money, but if you are able to pay it within the discount period, you can pay less money, right? So you can see that your accounts payable, let's say it's 100, but you only pay cash 90, right? Because there's a discount. So the purchase discount will reduce the inventory. So you credit the inventory for that 2%. So I'm going to show you here. We are talking about paying credit. So suppose when you first buy the inventory, you record $100, you owe $100. Okay. So that's why you make the purchase. But now you are paying it, it's still with the discount period. Let's say the discount period would be 30 days. Within 30 days, you have 2% off. And now you are making the payment on 20th day. So you are still within the 30-day period time. So you are eligible for that 2% discount. So your accounts payable here should be settled because it was 100. So you are settling that liability. So that should be offset. So you debit the accounts payable for 100. And because of discount of 2%, you only need to pay $98. So the $2 is the discount, right? It's the purchase discount. So purchase discount will reduce your inventory. So that's a credit inventory for $2. If you made the payment 40 days. So 40 days, that means you already missed that discount period. So you have no discount. So then your accounts payable will be 100, the cash will be 100. Okay. So you can see this scenario is with discount. This one is without discount. Does anyone have any question? If you understand, give me a thumb up. 1, 2, 3. Awesome. Thank you very much. Thank you. Okay, so that is my learning objective number 2.